Keefe, Bruyette Woods, a global investment bank that specializes exclusively in the financial services sector, released its industry outlook for 2011 today. Fred Cannon is the chief equity strategist and co-head of research at KBW. He joins us now live from his firm in New York. Good to have you, Fred. Thanks for joining the show.
Thanks. Great to be here.
Well, I know out of this survey you had several major themes, and one of which is that you're saying that U.S. financial services firms will actually shift from capital accumulation to capital deployment in 2011. So they're actually going to be spending the money as opposed to just saving it. But where are they going to be spending it?
That's right. After 2 years after the financial crisis, we think they're ready to start spending it. The challenge is, getting more loans out there and spending capital that way isn't going to happen very quickly because consumers are still deleveraging. So what we're going to see the financials do is focus on dividends first, some share repurchases, and M&A. We think M&A and the financial service sector really start to move up significantly next year.
Now, financial institutions have been coming under a lot of pressure. Many are losing some of their most profitable businesses, right? We've heard a lot of talk about proprietary trading no longer being part of banks. Credit derivatives is another big business that has been a big moneymaker for many institutions. It looks as if those desks are going to shrink pretty appreciably. And you said, you referred to it just there, consumers are not quite deleveraging and consumer lending not what it was. So where are the opportunities for growth in the redeployment of cash?
Well, a lot of the first two things we said about the redeployment of capital has nothing to do with growth. It has to do with getting that excess capital that's been built up back to shareholders. That helps share prices. It doesn't really grow the companies. We do think because of those pressures on revenue that mergers are going to happen. One way to grow the bottom line is to merge companies, save some costs. The other thing you mentioned is that we do think the banks are going to be looking at, especially the large banks, are going to be looking at non-bank acquisitions to try and recoup some of that fee income that they're losing, both on deposit fees and, as you said, on some of the investment banking areas.
Non-bank acquisitions would mean what?
It would mean a larger bank looking at an asset manager, looking at an insurance broker, looking at potentially exchanges, a lot of things where they can get fees that doesn't take a lot of capital, because that's what they'll be looking for.
Interesting. And then what about the Fed's current policies? How does that impact the industry? I mean, they've made money very cheap for banking institutions.
They have. I mean, in general, what the Fed has done with this low flat yield curve is make it tough on financials generally. And that's part of their plan, in my view. And that is, if the pressure is there, that means that they'll get the banks putting investments in somewhat riskier assets. And what we also think that means is this is also an opportunity for the banks to clean up their balance sheets going forward. In other words, those toxic assets that are still left from the financial crisis, by pushing down rates, we think that there's an improving bid for those assets. At the same time, the banks and the others are willing to sell them now that they have the reserves and capital up. So we think we'll see a fair amount of movement of those formerly toxic assets into the marketplace.
Well, we saw that State Street announcement today selling $11 billion of their, I don't know that they would qualify them as toxic assets, but selling assets, mortgage-backed securities, and other asset-backed securities, some of which may fall into that category. But let's talk for a second, because it's a little counterintuitive to me. If they're increasing, if they're making money cheap, the Fed, for these banks, how are they increasing their risk necessarily? I mean, there's a lot of regulatory pressure to not take risk on. So where exactly do they increase their risk?
Well, I mean, what I mean is the Fed's, by pushing the yield curve of treasuries down, they're essentially saying, hey, you can't make any money playing it safe. You got to take some risk, and so that's where you can say start to see some lending again is really what's starting to happen.
And that's something that we've seen really fall off, particularly in the consumer category. Let's quickly talk about the regulatory environment. There is a lot of debate about how exactly Dodd-Frank will be implemented. What do you see on that front?
Well, it's going to be pretty tough regulation. I mean, remember, as I think our Washington report came out today, it said, we've moved from Congress to the regulators now. Even with the congressional change, we don't think that Congress is going to have a big effect because it's all about implementation now. You're seeing some of those issues, today as the regulators start to look at all the different issues that hit Dodd-Frank. The most interesting one for most banking and most consumers is going to be the Consumer Financial Protection Agency and what it's up to next summer.
All right, and very quickly, what are your forecasts for GDP and unemployment? Obviously, this is an industry that hinges upon the success of the overall economy.
We're in the moderate, slow growth camp. We think this deleveraging that we're seeing at the banks isn't going to stop anytime soon. We have a 2% GDP growth next year, keeps rates low, doesn't do a lot for unemployment. We're hoping by the end of the year we might get below 9%.
All right, Fred, thanks so much for joining us today with the outlook for next year. It seems like it might be a better year, actually, for the banking industry. Expect some movement there. All right, Fred Cannon from KBW, Chief Equity Strategist there.